I'm very happy to welcome Mr. Richard Woolnough to TM Fund Research TV.
Hi.
Welcome. What are your expectations for the bond yields? Will we have to live longer with higher yields, or are we heading back to the lower interest rate environment?
That's really a question about where inflation is going to be. So if you think inflation is going to be back at 2, and if you think that the ECB will once again face the same problems that Japan has faced for a number of years of generating inflation, then obviously yields can come back to where they were before. Depends which inflation regime are you in. Are you in the one pre the Great Financial Crisis, let's say 2000-2008, the one post that, let's say 2008 through to 2018-19. We'll ignore the special situation that occurred in COVID where rates were exceptionally low. Very hopefully a one-off situation. Especially which inflation regime you're going back into. I think the main thing that's happened over the last 2 years is the politicians, the people, don't like inflation, and therefore the central banks will stay hawkish. We move to a low inflation environment. That won't be done overnight. It means, as you said, short rates will be higher for longer. But in the end, it's good news for fixed income, it's good news for assets, is that inflation will once again be bottled, will end up once again around that 2% and maybe below 2% level.
And where do you see default rates for corporate bonds over the next 2 or 3 years?
I think they'll be very low. I think the odds of recession are low. I think corporates are aware of the challenges that face them. The bond market is a lot more sophisticated than it used to be in terms of providing finance to companies. In the high yield market, there's a lot of ways to rescue companies that weren't available before. But in the investment grade area, lots of pre-funding has been done. They've learned from the Great Financial Crisis. They've learned not to borrow short, but to borrow long. And therefore that liquidity problem isn't likely to sit with them anymore. So I think the default rate's quite benign, quite light.
And which areas in the fixed income areas are you finding interesting, attractive?
Well, it's all fairly balanced. We think the economy will just be fine. The market's price would be the economy will be fine. So very strange for us, we don't have a strong view. Normally we have a view that's different from the market.
Okay. And how should investors, fixed income investors, position in regard to the duration?
It's quite interesting because obviously once you say you're a fixed income investor, you admit you're going to take duration risk because you've got a fixed income. And the whole point about fixed income, you have this risk of a capital loss and you have the potential for capital gain because your interest rate is fixed. This is very different from cash, where you can't make a capital gain or a capital loss, but your income can collapse to zero, like it has in the past, or could accelerate to new high levels. So for me, when you look at that risk reward, I think rates do not need to go any higher. And therefore, the odds of if you're a cash investor, your income stream is not going to go up, it's going to go down over time. If you're a fixed income investor, the risk of capital loss is limited and the potential for capital gain is quite large. So we look at that and we're long duration. So by saying what should a fixed interest investor be, when we look at our index and we look at our duration position, when we've been running this fund for 15 years, we're in the top 5-6% of our duration positions relative to where neutral would be for us. We're not excessively long because interest rates aren't super great, but they are interesting, and therefore fixed income investors have got a far better risk reward now than they had 5 or 6 years ago, pre-COVID, the last time we had a normal economy.
Last question, how would you say is a risk-reward relation compared to stocks?
It depends on your valuation point. So we do quite a lot of work looking at where bond yields are versus equity. And obviously stocks is a wide compass, there's very many of the stock markets around the world, and they tend to be a lot less correlated than the bond markets are. So when we look through the relative valuation of bonds versus equity on a simple basis, bonds do look good value versus equities. Whereas before in the past, equities at times look good value versus bonds. Where we have flexibility to buy equity risk, we own it. At the moment, we have a de minimis amount of equity risk. We're finding very few equities that are outstanding relative to bonds. And that's because we're not a multi-asset fund. We're a bond fund who, when equity looks really cheap versus high yield, we buy equity as an alternate to high yield because they're very correlated. So the equity market has always got some interest in there, but I leave that to my equity colleagues. For me, I only get involved when they're exceptionally good value. I'm very much a tourist in equities as opposed to an investment manager in equities.
Mr. Woolnough, thanks a lot for coming and answering the questions. Thanks.
Thank you very much. Thank you.